StatsCan says Canada's economy edged lower in April. Gross domestic product fell 0.1% compared to the month before, so worse than estimated. Manufacturing experiencing the biggest drop in April since 2021. Let's go to Sal Guatieri. He's director and senior economist with BMO Capital Markets. Sal, thanks for joining us.
Welcome.
So the expected weakness with everything that was going on in April, the big tariff announcements, were there any surprises for you in the sector details?
Not really, no. The weakness was concentrated in the areas you would expect, given that we saw the height of the trade war tensions in April. So manufacturing, in particular the auto industry, big pullback in activity, and as well just more broadly transportation, warehousing, which is largely tied to goods trade. So no surprises there. It is a bit disappointing that the economy actually contracted in the month, despite the fact that we got a bit of a push from the election-related activity and the hockey playoffs. So again, it does suggest the economy very vulnerable to this trade war. So contracted in April, appears to be the case in May as well. So not a great start to the second quarter. And that's very unfortunate because our economy was doing remarkably well in the previous 5 quarters, growing at upwards of a 2% rate. But it does seem to have hit that trade wall right at the start of the second quarter. And it does fit, unfortunately, with our view that the economy likely will contract through the spring and perhaps possibly through the summer.
You touched on a couple of things I want to look at a little bit more in detail, because we did get a boost in arts and entertainment, that sector, with 5 NHL teams, I guess, in the initial round of the playoffs. Did that surprise you?
Perhaps not really, no. Again, the boost from the hockey playoffs with, I think, 5 Canadian teams in the playoffs, that gave a little extra boost at this time of year. But as well, just more Canadians staying home, spending here than outside the country, trying to support our economy during this trade war. So I think that gave the leisure and hospitality industry a bit of a boost. It does seem like restaurants are a little busier these days, so not much surprise there at all. Again, the weakness, though, was concentrated in those trade-related areas.
You said you were surprised to see the weakness so early on with all of that sort of unraveling of the tariffs in April. May, as you mentioned, StatsCan is looking ahead, saying it should be about the same kind of drop, 0.1%. Why wouldn't May be worse, considering some of those effects would be felt more fully in May?
Well, there's lagged effects. Number one, most of the weakness in our economy will come through simply an outright decline in exports to the United States in response to those tariffs, largely in those 3 most hard-hit industries: autos, steel, and aluminum. So that we saw that in April. We'll likely see it again with the trade numbers in May. But on top of that, we are anticipating a pullback in business investment in Canada for a couple of quarters, simply tied to all the uncertainty about the trade war. So there's a couple things going on, both the hit to exports, but also a hit to business investment. And it's not just a 1-month phenomenon. That will be extended over several months, possibly a couple of quarters. And that's the main reason we do expect the economy to contract mildly for a couple of quarters this year.
Let's talk about unemployment as well. We're at 7% in the last check. Some are expecting that number to get closer to 8 by the end of the year. What do you see happening with employment?
Yeah, unfortunately, we do expect the unemployment rate to go up from 7% now to 7.7% by the end of this year. Again, all tied to the economic weakness related to the trade war. We're already seeing a pretty sharp slowing of job growth in this country. The past 4 months, basically, job growth has come to a stall. Not surprising, 4 straight months of outright declines in the manufacturing sector to May. So that really is what's pulling down overall job growth and pushing up the unemployment rate. And again, unfortunately, likely not to, we're not done there. Probably will see a further run up in the unemployment rate through the next several months.
We also had some data come out that showed that wage growth is surpassing inflation the last month that they looked at. I'm just wondering where you see the Bank of Canada sort of landing with all of the mixed information we have.
Yeah, the Bank of Canada has been in a bit of a tight spot. It's held back on or continuing the easing cycle the past two policy meetings now, simply because of, well, two things. One, inflation has been a little stickier than anticipated. Some of the core measures are running meaningfully above the 2% level. And the second reason is just there's so much uncertainty about how the economy will respond and how inflation will respond to these tariffs and counter tariffs that the Bank of Canada just sees the need, much like the Fed, to just wait it out to see more data on both the growth and the inflation impacts before adjusting policy further. We do expect the bank, though, to, once they see the unemployment rate continuing to drift higher, to put any inflation concerns at bay and resume cutting interest rates, possibly at the end of July, but further in the fall and around the turn of this year by a further 75 basis points.